Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for October 20th of 2024. Welcome again after another week's absence. Here we have quite a few things to talk about today. Obviously, we are heading precariously close to the election, and typically we see a little bit of turbulence in the market. A little bit of extra volatility heading into the election date. I can say it's probably been a lot more muted than we would have expected, but there has been a little bit of volatility here, and valuations we do know are somewhat stretched. We have some interesting data here kind of isolating large caps versus small caps, but there's an awful lot of liquidity that we're going to be talking about in the world, and I think that is going to help equity valuations looking ahead. And obviously, those valuations seem to be supported to some degree by earnings growth. And as we look at this chart right here, you have in the amber line the S&P 500 PE ratio, and it's set against the backdrop of the 2024 GDP consensus, which is on the left-hand scale. And very interestingly enough, you see here that a pretty good correlation between the multiple expansion that we saw as GDP estimates were moving higher as we exited 2023 and got into 2024. But now those GDP estimates seem to have kind of plateaued, and we'll see in a second with the Atlanta GDP Now estimate, which is a really, really good predictor of where GDP is going to come in at. But you can see that it seems to like slowly be ticking up here, but it's really has kind of plateaued. We've seen a deceleration in the rate of growth in those 2024 estimates here in the black line, and accordingly, you see multiples not expanding by as much as they were heading into the new year. Another very interesting statistic, and this is out of Haver Analytics, reported by B of A, that when you look at the global economy, or excuse me, the U.S. economy, and you look at the S&P 500, we often talk about how those two things are different in many ways, but they tend to, over long periods of time, move in the same direction. Obviously, the S&P 500 is a reflection of the overall economy, and one works generally at a lag to the other. But here we have a very interesting study here that services and goods in last 12 months earnings in the S&P 500 pretty much equal. But if you look at the overall economy, as we always talk about, that services are much more important to the overall economy than goods. And so when you think about where we are, we've been through kind of a manufacturing recession of sort, and we do have some data on manufacturing that, again, 1 month to the next, as we sit here right now, it seems to be a little bit better. But manufacturing is important, goods is important, the service economy is much more important. And as you can see here, there's some notable differences in the construction of the earnings profile for the S&P 500 versus the U.S. economy. Now on this slide, we're looking at real GDP growth and sector contributions, and these are in kind of gray shaded boxes, so maybe a little bit more difficult to interpret, but you'll have to indulge me on my interpretations here. But suffice it to say, in a data series that goes back to the third quarter of 2022, that consumption is very important, and it has been for a long time. And when we think about the overall economy, the consumption generally represents about 2/3 of it, maybe a little bit more than that, and certainly maybe a little bit less in some quarters, but by and large, it's 2/3 of 70% of the economy. And you can see that very well represented, not in the darkest shade here, the black area. That represents government spending, but the consumption is represented here in that next shade of kind of like that dark gray. And you can see how important it has been over time. Now, government spending at the bottom of this is also very important, but when you think about the increased burden of spending on the federal government, deficits that need to be funded by increased borrowing and borrowing costs that are higher than they were, and you're having to replace debt at lower interest rates with debt at higher interest rates, that over time you're going to have a bit of a crowding at it, and it's going to put more pressure on the private sector to fill that gap. Now, the rest of this investment here is related to business and residential investment, and you can see that from time to time it has a much greater influence, but consumption's the real driver here. And you can see in that amber line that represents the real GDP on a basically on a seasonally adjusted annual rate based on quarter over quarter data. And you can see that that number is kind of above 2, and third quarter of 23 it was above 4, but you can kind of get a sense of where that trend line is, and it's somewhere between really 2 and 4 on a fairly regular basis. And here we have the Atlanta Fed GDP Now estimate that I mentioned before. That's in the green line here. You can see that that's trending up, and it has been really for the last several months. And you can see juxtaposed against that is the blue shaded area of the consensus analyst forecast for the same thing. And this is an estimate for third quarter GDP, and we'll get the first revision of this in really the coming week here, and then that'll be revised twice and before it's deemed final. But you can see here that the third quarter estimate is now, from at least the Atlanta Fed's perspective, is a little bit above 3%, and historically it's had very strong predictive power, and it's been fairly accurate in its estimate. And you can see the consensus is in that blue line, and the average of the top and bottom 10 forecast is represented by that blue solid line. But estimates are looking a little bit better as we're kind of sitting at this point where people may be feeling a little bit more comfortable about the ability to achieve this soft landing and navigate this rate cycle that we're currently trying to unwind ourselves from. Now we have some slides on the labor market, and we've got 3 different representations of that up here. Up in this upper left corner, we have basically payroll gains that on a 3-month basis are trending lower. So this is what the Fed has been trying to engineer, a little bit of stability in the labor market, which, you know, if you kind of read through that, that means kind of slowing down this hot labor market that we've had. So initial jobless claims we have seen have picked up, although here lately, oddly enough, we've seen a little bit of a deceleration in that. And also up here, we have change in U.S. non-farm employment. That has been trending down for some time, but when you look at it on a year-over-year basis, I think 7% employment gains was something that is a little bit pie in the sky. And if we begin to see that we're leveling off, current estimates is a little bit lower than where we had been previously. And so, you know, we're kind of leveling off at what looks to be kind of a 2% year-over-year basis. Now we'll talk about retail sales, and this has been a little bit of a kind of a head scratcher of late. I'd say of late being about the last 3 to 6 months. You know, when you expect an economic slowdown, one of the things that you do expect to soften up is retail sales, and you can see here very clearly the actual numbers for September came in a little bit better than expected. They were expected to be positive, and they were a little bit better than that. And so you can see here in the red line that we look at it on a month-over-month basis, even though we've had some months that have been notably negative, that on balance, that if we look over the last year, that most of the data points have been positive. Then we slide all over here to the right, and you can see, you know, the derivation of that and kind of the categorically what's been strong and what hasn't. So we see furniture, electronic appliances. We've seen gasoline station sales, and a lot of that has to do with lower energy prices. Then on the flip side here, we have store retailers. We've got clothing, hair and personal care, and food and dining, which is really interesting. You know, that is evidence of fairly strong discretionary spending. Food and beverage could be grocery stores, and then we've got our retail sales control group, as well as overall retail sales being positive on that last monthly data point. So real strong performance from a good chunk of the retail sales backdrop here. On this slide, we have some data from Bloomberg with macro bond data layered in here. We've got 2 different data series, and on the left-hand side, we've got a measure of the tightness of money in the global financial environment. We see that here in the light blue line here. That's a global financial tightness indicator. And we push that forward 9 months as kind of a leading indicator. And in the black line, we see the ISM manufacturing, and that is on the right-hand scale. And as we know, the PMI is a diffusion index. And of course, during the pandemic, everything kind of slowed down. Then we had a big surge in manufacturing, and that completely rolled over, and we've been sluggish ever since. And we've been talking about this kind of like this manufacturing recession, rolling recession that we went through. Now, if you push forward, again, as we said, this kind of this tightness and this liquidity indicator here, we clearly see that that's moving higher, and it's in the positive. And so this would tend to bode well for overall growth looking ahead, because generally speaking, as you can see here, even though this is a bit noisy, you can see that the trend lines, though, would certainly suggest when you have conditions becoming easier, that over time you see that manufacturing backdrop continue to expand and get better. Well, and the thing I love about economics is that if you look hard enough, you can find data points that seem to offset maybe this prevailing point of view or the conventional wisdom, or whatever you want to call it. Well, conventional wisdom is that the economy is softening up a little bit, but we're achieving that kind of that real soft landing, if you will, kind of landing on that foam pillow, so to speak. Well, there are clearly other aspects that need to be considered. Here we have Chapter 11 filings that have clearly moved higher. Again, they were at a trough point, and if you look at a long-term trend, that would kind of put this in this range, and you can see that we've kind of punched through that over the last year. So, these are all things that we need to pay attention to. Is it something that is calling us to change our tune? No, not at all. But these are just emblematic of certain data points that you just can't ignore. Bankruptcies eventually could have a bearing on consumption, which we just talked about has been very strong, credit quality, and so on and so forth. So at this time, you look at this chart and you say, okay, well, this is a trend that certainly bears watching. But it's not a trend that gets you, I think, exceedingly nervous just at this point in time. Here we have some energy charts. We've got Brent crude right here. You can see that oil prices have been a bit volatile lately. As you can imagine, we've had a little bit of geopolitical risk in the Middle East, and so as you would guess, that tends to make things a little bit jumpy. So we did have a crest, an interim peak here, which was below the peaks that we saw earlier this year, March and June, July. And then where we are now is just, we have softened up a little bit. And so this, as I mentioned before, had a little bit of bearing on retail sales and sales at gasoline stations. But the other thing that is very interesting at this point in time, and we are in kind of a shoulder season in October, that, you do tend to see some increase in natural gas prices as you head into the heating season. We'll have to wait and see if that really plays out, because I think we have some pretty strong supply and demand factors that are at bay right now. Obviously, natural gas as a component of energy electrical production is fairly strong, but prices are very low because production's high. And then also you've got these crude prices, which have kind of settled in here a little bit as we head into the latter half of October and the beginning of November. So now we have consumer inflation expectations. You can see here, at least from the New York Fed's perspective, that we're pretty well anchored. In the 1 year, we're basically at 3%. Over 3 years, we're about 2.7%. This is above the Fed's 2% target, but they appear well anchored relative to the historical pre-pandemic backdrop. And then just as we were looking on the bankruptcy, the Chapter 11 filings, we have expectations for debt delinquency that have moved higher, and in some cases accelerated here, even though coming out of the pandemic, this has been a fairly long-term trend. It's a trend. It's just kind of accelerated here as of late. Here we have the Empire State Manufacturing Index. So we've talked a lot about manufacturing, and guess what? Things have been very sluggish. No surprise here. We had a little bit of a head fake. It went over zero in this case. The zero represents the diffusion point. So this is manufacturing expansion. And in the last data point, it was decidedly negative. In fact, well below the consensus. So it was a negative surprise at a time where we've been having a lot of positive surprises. Well, the takeaway in all of this, a silver lining, if there is one, is that the expected business conditions continue to improve. And so with this rate easing cycle now officially upon us, there's an increasing optimism out there, even though the current backdrop is not terribly great. There's an optimism out there that's, I think, pretty powerful. So now we'll begin to transition into some other data points that I thought were really interesting. And this one in particular, again, we had our 50 basis point rate cut here recently by the Federal Reserve. This is the federal funds effective rate here. So this is just another kind of a moniker, if you will, for short-term interest rates, which we know are between 4.75 and 5. And so this is 4.83 here, kind of in the middle of that. But the Federal Open Market Committee, presents a dot plot of their longer run inflation, of interest rate expectations. And they're currently about 2.9%. So we are well above that. And, this kind of goes back to this whole argument, or are we going to get another rate cut? I think the market's fully pricing in another 25 basis points or a quarter of a percent. There's much less consistency on the thought of a further 25 basis point cut. In fact, I think there's a case to be made that the Fed actually does nothing. Their next meeting is coming up literally the day after the presidential election. So I would not be surprised if they decided to hold on here as much as I wouldn't be surprised if they lowered rates by another quarter of a percent. So as we talk about the expectations for short-term interest rates, it certainly does have implications on long-term rates. As you saw, at least from the consumer's point of view at the New York Fed, in their survey, that expectations are pretty well anchored for inflation, which is in some cases helped to kind of allow interest rates to come down. We did see that a little bit here in October. This is the 10-year government bond yield. Right now, we are about 4.1%. And when we saw the retail sales number, this number really did kind of perk up because, again, with all the other stuff with bankruptcy filings and stuff that I've shown you that seem to kind of maybe make you a little uneasy about where things are, retail sales were pretty strong, and that caused those interest rates to move higher. And then here we have the 10 to 2-year government bond spread. And so when we talk about spreads, this is basically an indicator of the steepening of the yield curve. And of course, that's moving higher as well. We're about 12 basis points, or about 12/100% in difference between that 2 and the 10-year. Here we have the dollar with expectations of interest rates being maybe a little higher for a little bit longer. Certainly as we got stronger economic data, and it looked like even in the face of some of these other central banks that are lowering their rates right now, and maybe the Fed isn't going to be nearly as aggressive, that dollar index has really shot up. And so, this has maybe some implications. And of course, when you think about the equity markets, by and large, you don't want to have a super strong dollar. And why is that? Because your goods for export markets become more expensive. And that tends to slow things down from an export market, and especially considering that a very meaningful percentage of the S&P 500 earnings are generated from sales that are done abroad. And so if you have a strong dollar, then that tends to suppress things, so on and so forth. But this is a real strong breakout here, and it's something that we certainly want to watch if it reverses. But for the time being, when we feel like maybe there isn't as strong a case to rapidly drop rates because of the strength of the economy, at the same time that these other foreign central banks are dropping their rates, that's going to keep that dollar higher for longer. Here we have some Philly Fed data. I just showed you the Empire State data, and that was not terribly strong. But in Philly Fed, again, same deal. I mean, we've been in this rolling manufacturing recession, and these data points have been pretty lousy here lately. But we've had a little bit of strength, and we had I'd call it a head fake on the downside in the last couple months, and that's definitely gone the other way. And so just as we see like negative data points coming out of the New York Fed market, we're seeing more positive data points coming out of the Philly Fed market. And here, as we look at the overlay of the ISM manufacturing PMI, as well as that's in the purple line in the Philly Fed manufacturing index, as you would expect, these things tend to overlay fairly strongly here. And we have seen a little bit of a downtick around the 50 line. These are both diffusion indices. So as we've seen here, we've had negative performance out of the Philly Fed manufacturing index. Same deal here, but hopefully we'll see a little bit more strength here in the coming months, especially with this growing sense of optimism in the economy overall. We have seen a tremendous breakout in gold, and you can see that very clearly depicted in here. We do have gold allocations that obviously in hindsight, I wish we were much more greatly allocated to gold. The question is, in this kind of backdrop with a strong dollar, is gold going to be well supported? Now, I think gold can hold up here, certainly if the dollar remains strong, which I think it has the potential to be. But just as you saw a few charts ago, the dollar has had a real strong breakout, and that gold has followed along with it. And I just think that there are some limitations on how high gold can go from here. Now we'll talk about earnings per share, and again, not all boats are lifted equally, and we're about to learn a lot about what's going on across the different sectors of the economy. And you can see here that we really have two sets of data, and the light blue represents the S&P 500 earnings per sector that were in place as of June 30th. And the green here represent those same estimates for those same sectors on the 8th of October. And what's very interesting here, energy estimates have gone down. Obviously, energy prices are subdued. We just saw that. But in other areas of the economy, you can see, interestingly enough, where maybe those estimates have come down a little bit, which I think is healthy, because I think in many respects, estimates were perhaps a little bit too high. But again, you can see energy here. You can see that those estimates in communication services kind of held in there. Overall, S&P 500 estimates have come down. I think that helps to manage expectations a little bit. Healthcare estimates have come down. Industrial estimates have come down. Technology estimates are, I'd say, for the most part, kind of holding in there, whereas we've had degradation in materials, real estate, and utilities as well. Here we have a chart from a research piece that FS, Franklin Square, put out. And what's really interesting here is that we have a breakout in the dark bar here. These are the cyclical sectors, and this is a look at basically the historical backdrop in 2023. Again, S&P 500 annual EPS growth was really not that strong, but it was much stronger in, call it, the Mag 7, which is here, and then the defensive sector was positive, and then the cyclical earnings per share growth was actually negative. Now, again, all those are expected to change, and we're supposed to have it is expected that we're going to have much stronger earnings growth coming out of the cyclical sectors. And these are the companies that are characteristically strong. They pay dividends. They grow their dividends. They're basically strong, competitive, well-capitalized companies. And so we do have a definite emphasis in the portfolio in those sectors. The dots represent the S&P 500 itself, and so you can see 2024, we're overall expected to have about 10% earnings per share gain. That goes to something closer to 15 next year. Again, we've seen some degradation lately amongst earnings estimates. Looking into, probably the next 6 months, but 2025 is clearly looking stronger, particularly in cyclical sectors, and not so much notably in the Mag 7. You can see that Mag 7 earnings are expected to decline. And so I think what we're going to see is definitely a changing of leadership within the market, whereas, the Mag 7 was, the cat's meow in 2023, and has been to some degree in 2024. I think there's going to be much broader leadership in the market looking out into the next couple of years. And here we have another iteration of that next 12 months earnings per share. In the black line, that represents the S&P 500. What's very interesting here is in this purple line, this is the Russell 2000. So this characterizes smaller companies. And you can see that we're not having the same breakout in smaller companies. And there is a very stout valuation differential between the S&P 500, which, as we just saw, the next 12 months earnings per share is still kind of founded on the Mag 7 to some degree, but that is changing. And so over time, I would expect to see this kind of flatten out a little bit. And at the same time, I'd expect to see better performance from an earnings per share expectation standpoint coming out of the Russell 2000. So I think these two lines eventually converge at some point right around here. So very interestingly, in the market, we have a lot more optimism in stocks than we do in bonds. And so I point your attention to this bottom half here. So basically, this is a measure, again, another diffusion index. So stock sentiment less bond sentiment. And so if you have readings that are above zero, that indicates that you have very strong stock sentiment relative to bond sentiment. And that's been the case for at least a year and a half. And so in fact, by this indicator by Sentiment Trader, the latest reading is in the top 1% of all ratings since 1998. So very strong indicator and very supportive of money flows into stocks. Here we have a chart from B of A Research, which on the flip side, as we just showed you, stock sentiment is very strong relative to bonds. And so not too surprisingly, we've had a pretty massive reduction in allocations to bonds. And you can see that very poignantly displayed here, October 2024. And if you are a data point that I'm not sure just how far this time series goes back, but if they're measuring standard deviation based on data going back to the beginning of the century, then 2 standard deviations is statistically very significant. So very strong bond outflows at this juncture. Some other things that I think are really interesting in our marketplace, and I think to some degree helping to support the continued growth of the equity markets, and I think just the investment markets overall. In this left-hand side, we've got net foreign purchases of U.S. equities, really strong here, really strong. You see the latest data point here in that red column, but that is not limited to the equity market. You can see net foreign purchases of corporate bonds have been pretty strong right here, and corporate spreads have been fairly tight, and they're getting tighter, and that's very attractive, especially with a strong the dollar translated returns, both from a capital appreciation and dividend standpoint here, as well as a interest income standpoint here. If you translate those dollar denominated returns back to your home country, those are pretty strong. And so you can see that foreign purchases overall have really been a benefit to our market. So what's interesting, kind of in light of the foreign interest, is that right now we've got kind of an interesting dynamic. We've got tech sector outflows, and and I mentioned a few slides ago about their earnings expectations for the Mag 7 relative to the rest of the economy, looking out to 2025. That's, I think people are beginning to read into that, and the fact that we've got that we're likely to see more breadth in overall earnings growth across the entire market. And so we've seen some tech outflows as of late, although on a 4-week moving average basis, they're still positive, but in the latest data point, they were negative. And interestingly enough, even with that sentiment indicator strongly favoring stocks over bonds, that we've had a really strong inflow into investment grade bonds, that's IG, and especially if you look at it on a trend line basis, it's been exceptionally strong as of late. We continue our conversation of the Mag 7 versus the S&P 500. You can see this changing of the guard that I've been talking about. So, here's your forward earnings per share ratio and how it seems to be plateauing. It's been very strong, very, very strong. And but in the black line, you've got the Bloomberg Magnificent 7 or the Mag 7 price ratio divided by the overall market. And so when you see this accelerating as it did earlier this year, that means that the Mag 7 is really witnessing a breakout. And when it's really sluggish, as it has been over the last, call it, 4 or 5 months, that's indicative of a broadening out of the market, which I think is something that we all would love to see, and it's extremely healthy. Here we have sector returns in the S&P 500 after the Fed starts reducing rates, which they obviously just did in their last meeting. And so what's important on this slide is, you see technology over here, but it's not the most important sector. Historically, when the Fed starts to loosen rates, it gets into some of these discretionary areas. These are non-discretionary consumer staples, but healthcare is one, financials is another, consumer discretionary benefits tends to benefit a little bit more than technology sector does. So I really offer this chart to say, all those sectors that were playing second fiddle during the Mag 7 run-up tend to do well when the Fed starts reducing rates. And so a broadening out of the portfolio is certainly warranted here. So I mentioned a couple of slides ago, we've had corporate option adjusted spreads, which is OAS. It just means that these are spreads relative to the risk-free rate. And these spreads for investment grade bonds have really gone to the floor. And they've been really low for a while here. And this is an indication that the investment grade corporate bond market is very confident in our economic prospects, and they're not worried about recession. They're not worried about a big slowdown, because otherwise you'd see these spreads blow out and it would be a totally different story. And in addition to that, interestingly enough, the expectations are that we're going to have a lot more issuance. So you've got you have investment grade issuers. You have companies that are confident enough to want to jump back out and issue more debt. And again, they're confident about the economy, so they're very comfortable in doing that. And from a price dynamic standpoint, if you have more supply, that tends to depress prices a little bit, which in turn helps to keep those interest rates higher a little bit more, which I think is all feeding into this notion that we're going to normalize at longer term interest rates that, at points that are not terribly different from where we are right now. So in the last slide of the day, what I thought I would do is just offer up some analysis on liquidity. So on the left-hand side here, data from Macrobond. In this green line here, we've got basically a G10 global excess liquidity indicator, and so this is pushed forward by a year. So it is truly a leading economic indicator. So if you think about it, if you've got excess liquidity, that's got to find a home somewhere, and people want to return on that excess liquidity. And so oftentimes when liquidity is strong, it goes into companies, it goes into stocks, it goes into risk assets. And so this chart is trying to tell us that profits are apt to continue increasing because that liquidity is going to find its way to essentially income producing activities. And then over here, this is the global backdrop. And then over here, it kind of represents a little bit more of a US centric kind of issue. And then we've got free liquidity, again, pushed forward by a year. So it's the same dynamic that we have here, because liquidity is a leading indicator for future profits and equity growth. And you can see here in that dark line that liquidity is improving, just as it is here on the global backdrop. And that should definitely lead to stronger performance out of risk assets, including, but not exclusively, just the S&P 500 equal weighted index. Well, that's all we have today. Hope you've enjoyed the chart pack. Have a wonderful week, and we'll talk to you again soon.